But as Friday's jobs numbers reminded us, there is a big disconnect between financial markets, the fortunes of individual companies, even big ones, and the US economy as a whole. It's way too soon to write off this year. Markets are poor predictors of what happens to the economy as a whole. As a genius once said, the stock market has correctly predicted 9 of the last 5 recessions. In fact, in the last 50 years, we've had 29 market corrections, periods when equities were down by more than 10% from their recent highs, as we have now. But in that time, we've had only 7 recessions. The US economy had its best year in a decade in 2018, and despite the concerns in some quarters that all good things must come to an end, there's nothing yet to suggest that the momentum won't continue into 2019. In fact, the jobs report on Friday underscored just how strong the labour market is. It's so strong that men and women who for years have been discouraged from even looking for work are coming back into the labour force in their hundreds of thousands. There are few signs now of the kinds of stresses that usually derail an expansion. Inflation, financial excesses, a negative shock from overseas or at home. It will require deft management by the Fed and policymakers in Washington to keep the economy moving. And that's something perhaps we might lose some sleep over. But for now, there remains plenty to stay awake for in 2019. Well, to discuss all these issues and to look ahead to what will be a very busy year, I'm joined by Doug Holtz-Eakin. Doug was director of the Congressional Budget Office during the George W. Bush administration and is currently president of the American Action Forum, an economic think tank. Doug, thank you very much indeed for joining us, and a Happy New Year to you.
Thank you. Happy New Year.
As I said, we started the year, a year that was anticipated in tremendous gloom, a lot of financial uncertainty, a lot of worries, and it starts with a jobs report that looks like one of the best, if not the single best jobs report of this entire 10-year expansion. How do you explain the disconnect? What's going on?
I think there are 2 things going on. The stock market has had to adjust to the fact that the Fed is no longer buying up tons and tons of treasuries and mortgage-backed securities and pumping a lot of cash in there that can then chase stocks. The reverse is happening. They're normalizing interest rates, so money's more expensive. They're downsizing the portfolio. They're sopping up that excess cash. And so volatility has returned to the market. And I think it's taken a little adjustment. And I think equities a bit overvalued just because of the easy cash, and that went away. So that's just an underlying process. It's not a bad thing, hard to live through, I admit, but not a bad thing for the economy as a whole. The second piece is a harder piece, which is there is a lot of turbulence in the policy world. So if you think about the administration's approach to trade, it shifts seemingly every day. It's part of the president's tactics to catch people unawares. You walk out of a G20 summit and the 2 sides can't even agree on what they agreed upon. And the market sits and tries to sort out the future and what will be the international environment, what will be global growth, what will be U.S. growth. In the face of that, it's hard. That gets magnified by the fact that the Fed's trying to figure it out too, and the markets are trying to figure out what the Fed's going to do. So there's a lot of policy uncertainty that's roiling the markets, and that's a real thing.
Let's break it down to start with. So the jobs report on Friday was, as I say, remarkably good across the board. Jobs up, unemployment ticked up a little bit, but that was because people came back into the labour force. Wages were strong. That all points to a very strong economy. And yet, I suppose some people say the employment report is a backward-looking report. There are some concerns. There are signs perhaps the economy is slowing. How do you see 2019 unfolding? Is that momentum going to continue through this year?
I think the pessimism about a recession in 2019 is completely misplaced. You cannot get a recession in the United States without having the household sector go south. And there is no reason for a very strong household sector to somehow pull back that sharply. Over the final 3 months of 2018, payrolls expanded at a rate of about 7%. And that's a great annual growth rate. That's strong foundation for income. And we should see continued momentum into 2019. No question about it. Will the economy ultimately slow? Yes, it's inevitably going to slow. And the only question is toward what? Will we go back to 2%? Will we go back to maybe 2.5%? That'd be a fantastic long-run trend. That's the real issue. It's not a recession. It's what will the slowdown look like?
What could go wrong? I mean, one concern that people have obviously is with the market.
Sure.
The falls we saw in the market from their peak of a few months ago, people's confidence is hit, right? Their 401ks get hit. The housing market seems a bit weak as well at the moment right now. Could that feed through into a broader loss of confidence that, as you say, could really hit the household sector?
Well, you can tell stories about it all going wrong. There's no question about it. So we have some weak points in the U.S. economy. Housing sector is weak. No question about it. It's been a concern of mine for quite some time. If you look at CEO and CFO confidence, it's come down sharply, and they're talking about scaling back investment plans. If you layer on top of that slower global growth and what we've learned about the Chinese economy recently, you can tell a story where there's a synchronized global downshift and a loss of consumer confidence that would cause people to pull back. I don't think that's the most likely scenario, but you can't rule it out.
One of the concerns people have is the Fed. Obviously, people have talked a lot,
Right.
the president most notably, that the Fed is overdoing it, raising interest rates for the last few years, seems to be on a path to continue to raise interest rates, especially after the jobs report this year. Somebody once said, expansions don't die of old age, they're killed by the Federal Reserve. Is the Fed in danger of overdoing it?
The Fed has not overdone it. So let's talk about what we know so far. We're in an economy that's growing at about 3% plus or minus. The real federal funds rate is about 0. There is no way that that's overdoing it. So nothing the Fed has done so far and has happened so far, I think, should be in question. The real issue becomes, what is the number and pace of the hikes in 2019 and beyond? That's a fair reason for markets to be uncertain and try to sort that out. But given that they negotiated the end of 2018 so successfully, I'm surprised by the lack of confidence in the Fed's ability to continue to do that. They've done a tremendous job.
But we've
got rapid growth, low inflation.
They do seem to be backing off. They're backing off their sort of steady state of increasing interest rates. Markets expecting far fewer rates this year. The Fed seems to be validating that expectation. What do you expect the Fed to do this year?
I think the Fed has said very clearly that they're going to be data dependent, but they haven't said very clearly what that is. So that's a source of some uncertainty. I think what we're going to see the Fed do is move twice, maybe 3 times, and it's going to depend more on what the jobs report looks like in January, February, March than what the stock market looks like in those months. They are conscious of financial market conditions, but they are more conscious of what's going on in the Main Street economy, and they're monitoring it closely.
What about Washington, outside the Federal Reserve, the rest of Washington? Concerns there is obviously, as I said at the beginning, it's not exactly a spirit of bipartisanship we seem to have there. Government still shut down. What do you expect out of Washington? I mean, how much can that impact the economy? What do you expect out of Washington this year?
I think the government shutdown that we've seen so far has essentially no impact on the economy. It's a partial shutdown. Its duration, even if it goes for a month, it's not going to have a big impact on the performance of the economy. Stepping back to the larger picture on policy, there wasn't a lot that the president had on the agenda. It's not like he had a rich legislative agenda, said we've got to get this done. There was essentially nothing. And so I expect basically gridlock, a lot of non-policy investigations and efforts, a lot of testing of the waters for 2020 presidential elections. And the focus policy-wise will be on the Fed and will be on the administration's executive actions, the immigration moves, the trade moves. Those are the important things.